William Poole, the president of the St. Louis Federal Reserve Bank, said he would go along with a rate cut, but only reluctantly. Pushing more money into the banking system could be risky.
I am concerned that we are pouring gasoline rather than water onto this economy, Poole said. When it was Honig's turn to speak, he echoed these worries. I think President Poole said it best, that we could be pouring gasoline on this economy. I have concerns that a bubble economy syndrome may be building, he said. But Honig also said there were 3 good reasons to cut rates. First, he appreciated the danger posed by the foreign debt crises. Second, he didn't see signs of an immediate inflation threat. And finally, he believed that the Fed could raise interest rates again if the cuts proved unnecessary. Poole and Honig voted with Greenspan to cut rates. In 1999, shares of stock in a wireless telecommunications company called Qualcomm rose by 2,600%. This was the year that the S&P index jumped by 19.5%, and the Nasdaq nearly doubled. In an interview with the New York Times, Greg Maffei, the CEO of a fiber optics company called 360 Networks, explained the era succinctly. We had an enormous amount of relatively low-cost capital, Maffei said. When people throw a lot of money at things quickly, sometimes it's not all rational. Signs of price inflation were starting to emerge in 1999. In early 2000, Greenspan warned, during a public hearing in Congress, that the small rate hikes taken in the previous year would not be enough to slow economic growth that had grown overheated. Price inflation was gathering strength and would only rise more if the Fed didn't do something. The FOMC increased rates sharply after that, from 5.7% to 6.5%. This was the equivalent of hitting the emergency brakes on a subway train. The traders made a rapid transition in their thinking as they adjusted to a world where costs would be higher for money and for debt. They imposed a new framework on the value of the assets they were buying and selling. One such asset was shares of stock in a San Francisco-based company called Pets.com, which went public in February 2000. These shares were like those Florida land deeds Galbraith had written about. Quite suddenly, the traders started to re-examine the value of the real-world asset that underpinned the paper asset. They saw that Pets.com had failed to think about the high cost of shipping dog food. The company's stock had debuted at $11 a share, but began to fall steadily. This was the signal that the self-reinforcing logic of ever-rising asset values was over, and it was over because the Fed was raising rates. Pets.com declared bankruptcy in November. The stock market crash of 2000 wiped out $1.76 trillion of value in 280 internet stocks between March and November. The Federal Reserve had played a decisive role in creating, and then destroying, the multi-trillion-dollar stock market bubble. But when the market crashed, bankers, traders, and politicians turned to the Fed for help. The disaster only seemed to enhance Greenspan's reputation as a financial rescue artist. Only the Fed was believed to hold the power to recalibrate markets and avert a larger disaster. This fact revealed a third pillar of Greenspan's policy framework as Fed chairman. He chose to control price inflation, ignore asset inflation, and then step in and bail out the system when asset prices collapsed. This might seem like an odd strategy for a libertarian-leaning thinker who was vocal in his distaste for government intervention. But over the years, Greenspan learned that bailouts were unavoidable. Letting big banks and debt-laden governments fail was simply too painful to consider. This was another policy that developed slowly, with the accumulation of many independent decisions. As Sebastian Mallaby wrote in his biography of Greenspan, the Fed had bet its reputation on the proposition that it could clean up after the bubble. If it succeeded in that task, perhaps the downturn would be mild enough for the earlier boom to have been worth it. The cleanup job in 2000 and 2001 was enormous. But the Fed began quickly and forcefully cutting interest rates to 3.5% by August 2001. Honig was once again a voting member of the FOMC, and he largely supported this action. The Fed was built to offer cheap money during a crisis, and nobody could deny the market crash was a crisis. But the question was how far the Fed should go. This was where Honig started to part ways with Greenspan. In May, Greenspan wanted to cut the interest rate by a full 0.5%, an enormous change. Honig wasn't against easing, but he felt the Fed should move more slowly, giving time for its previous rate cuts to take hold. Honig's position was hardly radical. Rather than making a half-point cut, he argued to make a quarter-point cut. Mr. Chairman, I think we should pull back on the throttle today, Honig said. We've added significant liquidity to the market. Now we should let it work through and we should be far more cautious about further moves. Honig lost this argument. His dissent that month was only the second in his career, and he was the only member who voted no. On September 11, 2001, terrorists attacked the United States using hijacked airplanes, killing nearly 3,000 people and throwing the economy into chaos. This was an emergency on top of the ongoing economic emergency. The Fed responded with more interest rate cuts to cushion the blow, and nobody complained. But in December, Honig would cast his second dissenting vote of the year. When it was Honig's turn to talk at the FOMC meeting that month, he once again counseled caution and restraint, worrying about long and variable lags. He pointed out that interest rates had already been cut to 2% from more than 6% just 1 year earlier. "Mr. Chairman, I really think we ought to stay where we are. A 2% Fed funds rate is stimulative," Honig said. "We are seeing some signs of improvement, and not all of the stimulus has come into play yet. While I recognize that inflation is not an immediate issue, and I appreciate that, I still think we need to take a little longer run view at this time." Honig lost the argument, again the lone dissenter, and the Fed cut rates. A month later, Honig rotated off his seat as a voting member of the FOMC. Over the next 2 years, the Federal Reserve's state of emergency became almost permanent. The rate cuts of 2001 remained in place, with the cost of short-term loans staying below 2% until the middle of 2004. This era became comparable to the era of the 1960s, when monetary policy paved the way to an economic collapse. But this time would be different. Greenspan's policy of controlling price inflation and ignoring asset bubbles would take an extreme form during the 2000s. The Fed would play a pivotally important role in stoking the largest asset bubble, leading to the worst crash since the Great Depression. Once again, Tom Honig was there every step of the way. But this time he played an active role in the process. He rarely expressed regret about his votes on the FOMC, but the era of the housing bubble was an exception. Honig helped invite a bubble. Oceanofpdf.com. Chapter 5. The Overmighty Citizen, 2002 to 2010. It started in 2001, after the terrorist attacks and the stock market crash. The Fed was keeping rates low, and Honig was worried that the FOMC might once again be stoking asset bubbles in the Midwest. In March 2001, he cited a specific example, the housing industry. Honig was worried that low rates might push money out on the yield curve and into riskier loans in construction. "Banks in our region are beginning to lend more aggressively on real estate," Honig said during that month's FOMC meeting. "If rates stayed low, we could see a fairly dramatic shift of funds into that sector as people look to deploy their assets, which might cause some, for lack of a better word, overbuilding in the real estate area." During the meeting, Honig got into a back and forth with a Fed economist named David Stockton, who was presenting a national overview to the committee. Honig asked what effect low rates might have on the housing market, and Stockton said the low rates might indeed cause some investment errors. "It's very difficult for me to forecast the errors that banks might make, but they certainly have traditionally made those kinds of errors in previous long periods of economic strength," Stockton replied. The dangers of a housing bubble were not some wild theory or unexpected consequence of low rates. They were a predictable danger of cheap debt, but it was a danger that Greenspan and others on the FOMC felt was acceptable. Over the next few years, the Federal Reserve stimulated the economy by substituting one asset bubble for another, replacing the stock market bubble with the housing bubble. The theory was that a hot housing market would have spillover effects, creating jobs and encouraging spending and borrowing, and this theory proved to be true. During 2003 and 2004, the real estate business gained steam and the price of housing rose sharply across the county. Just as cheap debt increased farmland prices during the 1970s, low mortgage rates made it easier for people to borrow money and buy a house, increasing competition and pushing prices higher by the year. This dynamic was usually talked about in the same way that inflation in the stock market had been talked about during the late 1990s. It was described as a boom. Houses, like stocks, were described as a key source of middle-class wealth and a vital retirement investment, so the inflation of their value was welcomed as an unalloyed good. And, just as in the 1990s, it was only the rising specter of price inflation that forced the Fed to consider raising rates. By 2004, Alan Greenspan was worried that rates had been too low for too long. In May, the fingerprints of price inflation were unmistakable in the data that Greenspan reviewed. He pushed for the FOMC to tighten the money supply. For the first 6 months of 2004, interest rates were essentially flat, at 1%. Starting in June, the FOMC began to raise them slowly but steadily, ending the year at a little more than 2%. Honig voted in line with the FOMC at every meeting that year. The committee was moving in the direction that he believed was prudent. It was only later, looking back, that Honig realized that the damage was done. The Fed had kept rates at 1% for too long, and when it started raising rates it raised them so slowly that they were still accommodative, still incentivizing speculation and easy lending. "That left an impression on me," Honig recalled. "When you keep rates very low, even if you're raising them but you keep them very low, you are inviting bubbles." Between 2003 and 2007, the average home price in the United States rose by 38%, to the highest level ever. In 2006, Alan Greenspan retired as chairman of the Federal Reserve. He left with a virtually unblemished reputation. He was seen as the engineer of 15 years of nearly unbroken American prosperity. This was the shadow that loomed over his successor, Ben Bernanke. Americans didn't have a strong impression of Bernanke when he took the job. He was soft-spoken, even shy, and didn't generate strong reactions. This was true even among his fellow members on the FOMC, where Bernanke had served since he became a Fed governor in 2002. his tenure at the Fed was interrupted by a brief intermission, starting in 2005, when Bernanke was president of the White House's Council of Economic Advisers under George W. Bush. Honig, for one, didn't have much of a sense as to how Bernanke might lead the institution. He didn't know much about the former professor except that Bernanke was an inflation targeter, meaning that he, like Greenspan, would most likely focus on price inflation rather than asset bubbles. It was, in fact, the fear of price inflation that compelled Bernanke and the FOMC to raise interest rates sharply in the spring of 2006, pushing the short-term rate to roughly 5%, the highest it had been in years. Honig wasn't a voting member of the committee that year, but he supported what Bernanke was doing. In June, Bernanke proposed pushing rates even higher, raising them above 5%. This marks the first time that Honig expressed a serious disagreement with what Bernanke was doing, and the disagreement didn't make much sense to people who thought that Honig was a hard money inflation hawk. Honig believed that the Fed should stop raising rates. During the June meeting, he felt the need to voice his concerns, even if he wasn't a voting member. At the meeting, Bernanke went around the big table to hear from every regional bank president and gave the floor to Honig. "Thank you, Mr. Chairman. I'm glad that everyone agrees that the strength of a good committee is for someone to disagree, because my preference, based on the assessment of the outlook, is to maintain the funds rate at 5%, and I would vote accordingly if I were a voting member," Honig said. He pointed out that the Fed might be overshooting its target, raising rates so high that they might have more of a disruptive effect on the economy than the Fed intended. "So I would hold off, I would be patient, and I would be firm in keeping the rate at 5%, Honig said. "President Honig," Bernanke replied, "I think everyone around the table admires you for your consistent position." The comment evoked laughter in the room. It wasn't entirely what Bernanke meant by consistent, but Honig took it as a reference to his reputation as a Fed hawk. Honig replied, "That's a generous word, but thank you." Bernanke was correct that there was a certain consistency expressed in Honig's concerns at that meeting. By 2006, Honig had a coherent view of how the Fed should conduct monetary policy, which he had developed over 30 years at the central bank. It would be too simplistic to say that Honig was an inflation hawk. But he also certainly wasn't a dove. If there was a single phrase that might capture his philosophy, it was a rules-based approach. This was one that emphasized restraint, incrementalism, and limits on how far the Fed should push its powers. The first pillar of the approach was the law of long and variable lags. If there was one thing Honig had learned, it was that the Fed's leaders, who were only human, tended to focus on short-term events and the headlines that surrounded them. But the Fed's actions were expressed in the real world over the long term, after they had time to work their way through the financial system. When there was turmoil in the markets, the Fed leaders wanted to take immediate action, to do something. But their actions always played out over months or years and tended to affect the economy in unexpected ways. The second pillar of Honig's view was that the Fed should focus on both of the inflation cousins, asset inflation and price inflation. It was true that detecting out-of-control asset inflation was more difficult than detecting price inflation. And asset inflation was harder to stop without disrupting markets and making prices fall. But the results of asset inflation were devastating. When asset prices eventually corrected, and they always did, it caused massive financial instability. If the Fed achieved 5% unemployment by encouraging asset inflation, it would have to contend with the 10% unemployment on the other side of the correction. This required the Fed to make ever larger interventions to repair the damage from asset bubbles. The third and final pillar of Honig's view was that the Fed should show restraint and follow rules that it imposed on itself. It should not push interest rates too low, too fast, nor hold them there too long. And the Fed should show restraint on the other side of the equation as well. It should not raise interest rates too high, too fast, if it was worried about inflation, because it might cause a precipitous collapse. The need for restraint was made more important by the law of long and variable lags. Because it took so long for the Fed's actions to have an effect, Honig believed the FOMC needed to patiently monitor conditions in the real world to measure the effects of what they had already done before doing something more. Keeping their actions within a narrow band helped ensure they didn't overdo it on the upside or the downside of an economic cycle before they even knew how economic actors would react. This kind of restraint had once been imposed on the Fed by the gold standard, but the gold standard was arbitrary and unworkable in its own way. If the gold standard worked, people would still be using it. But without the gold standard, central bank leaders had to figure out how to impose discipline on the money supply. There was really only one solution. They had to replace the tyrannical restraint of the gold supply with the restraining power of their own wisdom and discretion. This view, Honig's view, was the opposite of heroic. It was a mode of leadership built on unhappy compromise, focused on results that wouldn't be evident for months or even years. Its unpopularity seemed guaranteed. No one wanted to celebrate a Fed official who sought to make the central bank more boring, more limited, or less central to American economic affairs. When the laughter subsided after Bernanke's comment, Honig's consistency was disregarded. The short-term interest rate was hiked another 0.25% to 5.25%, where it would remain through the year. At this time, some parts of the housing market were beginning to display signs of weakness, particularly in the category of riskier, subprime, home loans. In late October, Honig was invited to give a speech to a group of bank directors at their annual symposium in Tucson, Arizona. This was a regular part of his job. Honig had been interacting with bankers throughout the Midwest since the Fed first hired him in 1973. But the banks he interacted with in 2006 were very different from the banks he dealt with earlier. They were larger, more far-reaching, and more deeply intertwined with one another than ever before. After the banking crisis of the 1980s, Congress relaxed the laws that prohibited banks from doing business in multiple states, hoping to make it easier for the survivors to stay in business. Loosening the interstate banking laws allowed stronger banks to buy up weaker competitors, paving the way for a new breed of giants. Continental Illinois had been deemed too big to fail in the 1980s, but it was a small bank compared to some of those the Federal Reserve was now charged with regulating. What worried Honig, as he traveled to Arizona, wasn't just the size and the scale of the new banking corporations. It was what they were doing. These bigger banks were making the same kinds of loans that marked the boom years of the late 1970s. Back then, Penn Square made risky oil loans and sold them off as participations. In the mid-2000s, mortgage lenders extended risky home loans and sold them off as mortgage-backed securities. The atmosphere at banking conventions tends to be chummy and exclusive. The symposium in October was held at the JW Marriott Star Pass Resort on the edge of Tucson, and the resort felt like an island. It contained a golf course and a pool near an outdoor dining area with couches and small adobe fire pits. The rooms had balconies from which guests could overlook the rolling mountain ranges to the west. This was the kind of place that bankers congregate to talk shop and make connections. Honig moved easily through such places and was treated like visiting royalty. His presence at such an event brought prestige and made attendees feel like they had inside access to power. The symposium agenda said that Honig would deliver a speech entitled, "This Time It's Different." This was catnip for a banker. It fed the general sense, in 2006, that banking and finance were driven by new and sophisticated insights. This was the age of the quants, meaning analysts who bought and sold stock using software algorithms, and the private equity kings who earned billions through buyouts and corporate turnarounds. When the time for Honig's speech approached, the bankers filed into a conference room and took their seats, ready to hear how this time was different. Honig walked to the podium, looked out over the crowd, and began to speak. What followed was the equivalent of a close relative showing up at Thanksgiving dinner, standing up to offer a toast, and then proceeding to give a lengthy speech about grandma's debilitating alcoholism and the emotional damage that it had inflicted on everyone at the table. The speech was not designed to comfort. Asset values are appreciating, farmland values are strong, and we are all well aware of what has occurred this year with the energy markets. In short, for many in this area of the country, times are good, he began. But then he pointed out that times had also been good back in the early 1980s, when asset prices were also rising. But the collapse wiped out 309 banks in the Kansas City Fed District alone. Let me share with you some statements that we actually heard from bankers and bank directors during the 80s, Honig said. He recalled bankers telling him, if you understood this better, you wouldn't have a problem with it, and, yes, we loaned 100% on this project, but everyone knows that the collateral value can only go up during construction, and, although this is unconventional, our accountant says it is perfectly legal, and, the corporate plane will save money for the bank in the long run. In case the audience missed his point, Honig made it explicit. Age-old behaviors, such as greed, short-sightedness, and arrogance, are at the center of these problems, and, I would caution, they are with us today just as they were in the 1980s. Banks might be larger, and the financial instruments at their disposal more complex, but at root things were not in fact different in 2006 than they had been before. When asset prices were rising and debt was cheap, it induced reckless behavior. Honig told the story of Penn Square in Continental Illinois, and how the reckless behavior of one bank fed into the others. The simple fact is there are times when it is wise not to jump on the bandwagon. In some instances, it is better to let the parade pass you by, Honig said. As directors, you should be extremely cautious if your management can't fully and clearly explain the business lines they are about to enter or if there is too much of a rush to jump in. Honig ended his speech by saying that if things were to end up differently in 2006, it would only be because bank directors, the very people in the audience that night, chose to be more skeptical, more restrained, and more focused on oversight. When I finished, Honig recalled, I got stone silence. A few months later, in March 2007, Ben Bernanke was invited to testify before the Congressional Joint Economic Committee. Bernanke did not have Greenspan's celebrity status, but he was still a trusted voice on Capitol Hill. He seemed to speak in actual English, even when delivering bad news, and the news wasn't good in 2007. Economic growth in the United States has slowed in recent quarters, he said. The principal source of the slowdown in economic growth that began last spring has been the substantial correction in the housing market. Still, Bernanke assured lawmakers that they didn't need to be overly worried. The slowdown just meant that the economy was transitioning to a more sustainable pace of growth. The Fed wanted to slow the economy and was doing its job well, he suggested. Bernanke acknowledged that higher interest rates would probably cut demand for houses. Home foreclosures would probably increase, and there would be some damage. At this juncture, however, the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained, he said. The problems were not contained. For roughly 6 years, the American financial system had arranged itself around the central, nourishing flow of cheap money. When the Fed raised interest rates throughout 2006 and 2007, the effects rippled outward through the economic system and shook it apart. The big tremors began in August 2007, when BNP Paribas, a French banking giant, said it couldn't accurately price some securities based on home loans. This meant that the bank couldn't figure out what the loans were really worth, raising questions about the value of underlying assets that banks depended on for their solvency. Things unraveled relatively quickly after that. The average housing price fell by 10% in a year, a wrenching downward correction for middle-class wealth. By the start of 2009, housing prices had fallen by 20% overall. In 2 short years, Americans lost about $10 trillion in wealth. The losses were felt at big banks and investment funds, which had been counting mortgage loans as valuable assets on their books. Many faced imminent collapse, just like Continental Illinois when the value of risky energy loans corrected. The stock market crashed in late 2008 when the banking wreckage became obvious, wiping out about $8 trillion in wealth over 2 years. It was the worst economic downturn since the Great Depression. The crash of 2008 illuminated the deep disparity that had developed between the power of the Federal Reserve and the power of fiscal authorities like Congress and the White House. The fiscal authorities were exposed as slow and ineffective, while the monetary authority of the Federal Reserve emerged as robust, keenly maintained, and fast-moving. The Obama administration first sought to ensure that the big banks were recapitalized. The Secretary of the Treasury, Timothy Geithner, had previously been president of the New York Federal Reserve. Geithner's approach to the crisis embodied the modern Democratic Party's theory of bank regulation. The top priority was to protect the financial stability of banks rather than to close them down or restructure them as FDR had done during the Great Depression. Geithner famously described this strategy as putting foam on the runway. He intended to help the banks make a smooth crash landing and to recover as quickly as possible. The foaming had begun before Obama took office, when Congress passed a $700 billion relief package for the banks. To repair the broader damage to the economy, the new administration followed the Keynesian path, spending government money at a moment when the private sector was pulling back. The goal was to stimulate demand and to cushion the downturn, but the effort was hobbled by strong Republican opposition to government spending. Obama began from a position of compromise, presenting a plan that his administration believed might appeal to Republicans. A large portion of the resulting stimulus package came in the form of tax cuts. The total package amounted to roughly $787 billion, although later estimates said the true amount added up to $862 billion. This was still not nearly large enough to replace the demand that had been lost. These fiscal programs were dwarfed by the Federal Reserve's actions, the scope and speed of which weren't truly revealed for many years. The Fed had printed and disbursed more than $1 trillion while Congress was still arguing over the language of the stimulus bill. As Bloomberg News and the economic historian Adam Tooze later revealed, a lot of this money from the Fed went directly to foreign banks that were in danger of collapse. The Fed opened swap lines with foreign central banks, primarily in Europe, and traded newly created dollars for those banks' foreign currency at a discounted rate. The Fed was also active on behalf of banks at home. In late 2008, the Fed engaged for the first time in quantitative easing. It bought about $600 billion in bonds from banks, placing all the new money it created for the purchase directly in their reserve accounts. The Fed's actions seemed like they were very complicated and sophisticated, an impression that was reinforced when the emergency lending programs were labeled with a wild menagerie of incomprehensible acronyms like TAF, Term Auction Facility, TSLF, Term Securities Lending Facility, and PDCF, Primary Dealer Credit Facility. But this was Fed speak. The Fed's actions amounted to one basic thing. It created new dollars on Wall Street through the accounts of a small club of primary dealers. And it did so at a scale that was unprecedented. It is easiest to grasp the scale of the Fed's actions by comparing them with what the central bank had done over the previous century. Between 1913 and 2008, the Federal Reserve printed more dollars every year at a steady gradual pace, increasing the supply of new money, called the monetary base. Between 1960 and 2007, the Fed increased the monetary base by $788 billion. During the bailouts of 2008, the Fed printed nearly $875 billion. It more than doubled the monetary base in a matter of months. Another way to measure the size of the Fed's interventions is to look at its balance sheet. When the Fed buys something, it takes it onto its balance sheet, which reflects how many dollars the Fed has injected into the banking system. In just a few months after the stock market crash of September, the Fed's balance sheet grew by $1.35 trillion, more than doubling the assets it already had on its books. All of this was done with the understanding that these were emergency actions, an extraordinary attempt to confront an extraordinary danger. The financial panic of 2008 threatened to plunge the global economy into a deep depression. The financial system had seized up, and banks had ceased doing business with one another because nobody knew who was broke and who wasn't. The Fed stepped in, as it had been designed to do, and short-circuited the panic. Tom Hoenig voted to support each and every one of these actions when they were presented to the FOMC in a series of emergency meetings. He believed that this was the Fed's job. But the question, for him, was what would happen afterward when the emergency passed. This was where the hard decisions would have to be made. When the crash of 2008 ended, it was immediately obvious that the damage would be long-lasting. Ben Bernanke himself had written the paper explaining how the downturn of 1991 led to a jobless recovery in part because of an overhang of bad debt. The overhang in 2009 was almost unimaginably larger. This wasn't just a matter of paying off old credit card bills or car loans. Millions of families were evicted, a wrenching process that played out over a decade, with 8 million mortgage foreclosures between 2007 and 2016. The long-term damage was foreseen at the time. Economists at the University of California, Los Angeles, estimated in early 2009 that the unemployment rate would still be above 9% by the end of 2011, when the country would still have about 4 million fewer jobs than in 2007. This was echoed by others, like the economist Mark Zandi, who estimated that the unemployment rate wouldn't fall back to 4% until 2014 unless Congress passed a major stimulus bill. Barack Obama did sign the stimulus bill a month later, but it was the last major fiscal action in response to the crash. Congress turned its energies after that to the passage of the Affordable Care Act and a financial reform bill called the Dodd-Frank Act. The conservative Tea Party movement gathered strength as these measures were debated and helped Republicans take control of the House during the midterm elections of 2010. All of this put even more pressure on central banks to act. Paul Tucker, a senior official at the Bank of England, experienced the pressure firsthand. After Tucker left the central bank in 2013, he wrote the FedSpeak equivalent of a whistleblower's inside account of modern central banking. His book was called Unelected Power and discussed the ways in which democratic institutions were increasingly shifting power to non-democratic institutions, like the military, the courts, and central banks. The banks were among the last institutions that could act quickly and decisively. This was by design, but the banks were also designed to operate with a narrow focus. The most important constraint is that elected politicians should not be able, in effect, to delegate fiscal policy to the central bank simply because they cannot agree or act themselves, Tucker wrote. He pointed out that doing so creates a self-fulfilling prophecy. The more central banks can do, the less the elected fiscal authority will be incentivized to do, creating a tension with our deepest political values. When this happens, central banks became overmighty citizens, Tucker wrote, capable of imposing sweeping changes on national life without the democratic accountability of democratic institutions. In 2010, as Congress effectively ceased to operate, the Federal Reserve took upon itself the job of stoking economic growth, a task that had once been the responsibility of fiscal authorities. If the Fed was an overmighty citizen, then its committee of 12 people on the FOMC faced more pressure with each vote that they cast. In nearly 20 years as an FOMC member, Hoenig had cast 48 votes. He dissented 4 times in that period, or about 8% of the time. That might sound like a lot of dissent, by the standards of a consensus-driven committee, but it meant he still voted with the majority more than 90% of the time. In 2010, it was Hoenig's turn to rotate back in as a voting member. Hoenig could sense the uneasiness in the room when he voted against Chairman Bernanke. In 2010, when he voted against the chairman at every single meeting, the uneasiness spilled into almost every corner of his professional life. Each of his no votes telegraphed to the outside world that there was at least some level of dissension within the Fed, perhaps undermining faith in its actions. It also telegraphed that the Fed was making policy decisions subject to debate. At professional conferences and meetings, Hoenig's peers expressed their uneasiness in the form of questions they asked him. Are you sure you're doing the right thing? Do you really think you should do this? It's not that you're being lobbied during the FOMC meeting at all. It's just that, as you vote no consistently, people kind of look at you as, this is very unusual, as even the media is saying it's very unusual. So it's not hard to pick up the tone. It's a very serious matter, Hoenig recalled. You really are affecting the economy and therefore the lives of many people, and to be an outlier is not the safest place to be. Hoenig was pained at the memory of keeping interest rates too low during 2004, feeding the housing bubble. In 2010, the Fed kept rates at zero and gave forward guidance that assured bankers the rates would stay at zero for a long time, giving them more certainty to make speculative bets. The zero rate incentivized bankers to reach for yield and make risky loans. Once again, the Fed would try to stoke economic growth by stoking asset bubbles, and betting that it could clean up the mess if those bubbles collapsed. In August, Ben Bernanke announced the plan to push the Fed's efforts further, by pumping $600 billion into the banking system through quantitative easing, even though the economy was starting to grow again. It was true that unemployment was still high, but the economists knew that it would remain high by the end of 2010. The Fed's leadership felt the need to do something about it, to ease conditions as the economy recovered in the hopes that it might speed up the process. It was presented as an insurance policy that could be reversed if needed. On November 3, this proposition was put before the FOMC. Bernanke called the roll, and it was Tom Hoenig's time to vote. Aye. The gold supply was influenced by geological factors that had nothing to do with monetary policy. For instance, the discovery of a big new gold mine in Alaska could randomly increase the money supply. This helps explain why the gold standard era was characterized by bank panics, long bouts of deflation, and periodic depressions. Also, for the gold standard to work, nations need to accept punishing bouts of deflation at times, which very few are willing to do. Oceanofpdf.com. Chapter 6. The Money Bomb, 2010 to 2012. Respectfully, no. After he had cast his vote, Tom Hoenig sat through the formalities while the FOMC meeting wrapped up. When the proceedings were finished, the committee members and staffers gathered their things and chatted politely as they filed out into the hallway and toward the elevators. Hoenig's car was waiting for him downstairs, and he caught a flight to Kansas City. Back in Missouri, it took about 45 minutes to drive from the airport to Hoenig's house, a stately red brick Tudor that sat on a tree-lined avenue in the historic Brookside neighborhood. Cynthia could tell when her husband was under extreme stress, because he got really quiet. Hoenig was really quiet when he got home from the FOMC meetings in 2010. He retreated to his study, a converted bedroom upstairs, and closed the door. Hoenig couldn't talk about what had happened in Washington, because the FOMC proceedings were confidential. But Cynthia would read about the no vote in the media because the final vote tally was made public. I could see that it kind of physically wore him to have to do that. Because who wants to be not in the general consensus on things? Cynthia said. Much later, Cynthia and Tom were at a social event, and she overheard him describe to a colleague how it felt to be the lone dissenter. He said it was the most daunting thing you'll ever experience. To sit in a room, and your vote comes around, and you say no. He said you never take that lightly. Hoenig knew that his vote wasn't going to actually change anything. The FOMC had all but decided to undertake quantitative easing before the meeting even started. He voted no because he felt it was his duty. But there was another reason that he did it. He was sending a message to the American public. His vote was a signal that there was, in fact, dissent over what the Fed was about to do. There had been an argument about it, and at least one person had believed that the risks of quantitative easing were too high to justify. Unfortunately, Hoenig's message could only reach the public in one way. The signal had to travel through the American media ecosystem of cable news shows, newspaper articles, financial wire services, and increasingly popular partisan websites. This media system was fractured and degraded in 2010 in ways that both mirrored and accelerated the decay of America's democratic institutions. This was a primary reason why quantitative easing and 0% interest rates were the most important economic policy of the decade, while also being one of the least discussed. The Fed's policies were an obsession for only a small fragment of the conservative movement, but almost totally ignored by everyone else. Years later, an economist named Carola Binder analyzed media coverage of the Fed and quantitative easing between 2007 and 2011, using a database of more than 300,000 news stories. The results showed that the Fed's policies barely made the news. President Barack Obama, for example, was the lead newsmaker of about 8% of all stories. Ben Bernanke was the lead newsmaker in 0.13% of stories. When the Fed was written about, it was only written about when there was some kind of ready-made press conference, like Bernanke's testimony before Congress. FOMC meetings were virtually never covered. The only outlets that did regularly cover the Fed were specialized financial news services, like Bloomberg News, which sent reporters to cover even minor Fed events like speeches by regional bank presidents. But their coverage tended to focus on one thing: what the Fed was about to do and how it would affect markets. It was coverage written for Wall Street traders and barely written in English. It didn't penetrate the broader discussion. I would say that most people wouldn't have any idea what quantitative easing even was, Binder said. On the night that Hoenig cast his dissent, Fox News aired a segment about quantitative easing that lasted for more than 14 minutes, an eternity by the standards of television news. The impact of this segment would be disproportionately large because roughly 47% of American conservatives relied on Fox for a majority of their news. There was no equivalent network for American liberals, who divided their attention among outlets that included National Public Radio, CNN, The New York Times, and MSNBC. Fox's primetime segment on quantitative easing reached several million viewers. It was presented by one of the network's most popular personalities, the former radio show host Glenn Beck. His understanding of the Federal Reserve was like that of a very high drug user who had sat in a motel room, trying to eavesdrop through the wall as people in the next room talked about central banking. He sometimes said things that resembled the truth, but he ultimately left his viewers far less informed about the Fed than when he began talking. Beck's preferred costume for television was a rumpled suit and tennis shoes. His thick-rimmed glasses and crew cut evoked a high school social studies teacher in the early 1960s. His viewers trusted him, almost to a religious degree. Beck was a driving voice of the Tea Party movement, and his primary expertise was describing wide-ranging and malevolent conspiracies. On the evening of November 3, Beck scrawled a long numeral on a chalkboard, 600 billion. This represented the value of bonds the Fed just announced it would buy. This is what they call quantitative easing, Beck said. Then he walked to a new chalkboard with a confusing flowchart written across it that included a series of large, cartoonish arrows that seemed to signify the flow of money, or influence, or something like that, behind the Fed's new program. Confusingly, the whole thing began with organized labor, depicted by a union boss wearing a bowler's cap and with a cigar dangling from his mouth. It got weirder and increasingly inaccurate from there. The final cartoon on the flowchart showed a group of top hat-wearing bankers, at which point Beck delivered his final, climactic revelation. "I thought we hated bankers, right? No, no, no. This is actually the Fed," he said, getting excited now, barking out his words. "What is the Fed? Don't worry. Just a collection of big bankers. You know, the Goldman Sachs. We don't really know for sure because we're not allowed to look." "Oh, that sounds honest. So you go to the bankers, and the bankers say, 'Don't worry. We're going to go to the Treasury and print more money. We'll just print more money. And then we'll take this money off the printing press and buy your bonds,'" he said. He concluded. "You know where that leaves us. Extra broke." Most of this was wrong. The Fed isn't made up of a collection of big bankers. It doesn't rely on the Treasury to print money. And quantitative easing wasn't going to leave America broke but would leave it the opposite of broke, with trillions of new dollars injected into the financial system. The only important thing Beck got right was pointing out that quantitative easing would hurt people who saved money. But his speech overall was a significant tragedy. His broadcast helped set the agenda that conservatives cared about in 2010. Conservatives cared about the Federal Reserve far more than liberals seemed to. On November 3, quantitative easing was the top story on the conservative Drudge Report website, which featured a headline written in big red letters that said, "Big New Pump." The liberal Huffington Post, by contrast, appears not to have run any stories about quantitative easing on its homepage in the days after it was announced. But the conservative media covered quantitative easing in a specific way, with a deep concern about price inflation. The coverage focused on the fact that the plan would likely devalue the dollar, which sounded vaguely unpatriotic, as if it weakened the nation. Glenn Beck repeatedly mentioned the threat of hyperinflation during his long segment. "It will be the Weimar Republic moment," Beck said, referring to the hyperinflation that plagued Germany before the rise of the Nazi Party. The Fed was, in fact, trying to devalue the dollar. The Dallas Fed president, Richard Fisher, pointed this out during the internal FOMC debates. "Another desired benefit, as you outlined it yesterday, Mr. Chairman, is to devalue the dollar to stimulate demand for our exports, and I don't think we should ever say that publicly," Fisher said. Devaluing the dollar wasn't seen as all bad inside the FOMC. It made American products cheaper overseas, which could stimulate exports and create jobs. But conservative critics of the Fed saw devaluation as near treasonous. The conservative author James Rickards published a book in 2011 called Currency Wars: The Making of the Next Global Crisis. Rickards was a former lawyer for the hedge fund Long-Term Capital Management, which had nearly destroyed the financial system when it collapsed in the late 1990s. His book took fears of devaluation to their most extreme possible conclusion, warning that it would lead to coordinated efforts between Russia and China to dump American debt, devalue their own currency, and destabilize the American economy. The success of Currency Wars led to a series of books by Rickards, with thematically identical covers and titles like The Road to Ruin, Aftermath, and The Death of Money. These books, and other conservative coverage, helped to dampen criticism of the Fed and quantitative easing because the program's critics looked like right-wing cranks. People like Rickards predicted the most catastrophic possible outcomes, like hyperinflation, but those outcomes never happened over the following 10 years. The Fed's actions did pressure other central banks to follow its lead, and to print more money through their own quantitative easing programs, but it was hardly a currency war. And, as had been the case over the previous decade, price inflation never rose to a serious level, let alone hyperinflation. The extremity of conservative arguments made them easy to dismiss. These arguments swept up Tom Honig's dissent in their undertow. This is how the image hardened over the ensuing years that Honig had been opposed to quantitative easing because it would lead to price inflation or hyperinflation. The focus on price inflation allowed supporters of quantitative easing to declare victory each year that prices didn't rise sharply. Ben Bernanke helped entrench this narrative. Shortly after the vote on November 3, Bernanke appeared on 60 Minutes. It was Bernanke's second appearance on the show. The year before, he'd given a long interview that featured a segment filmed in Bernanke's small hometown of Dillon, South Carolina. He and the 60 Minutes host Scott Pelley sat on a bench on Main Street, outside the humble building where Bernanke's grandfather once ran a drugstore. "I come from Main Street. This is my background," Bernanke said. In 2010, Bernanke defended the unprecedented experiment that the Fed was undertaking. Pelley gave an accurate overview of how quantitative easing would work. But when he asked Bernanke about the possible downsides of the program, Pelley only focused on one thing: price inflation. Critics of Bernanke's Federal Reserve say that the $600 billion, and holding down interest rates, could overheat the recovering economy, causing prices to rise out of control, Pelley said. This defined the line of questioning that was fired at Bernanke, and it dramatically narrowed the nature of the true criticism raised inside FOMC meetings by Honig, Richard Fisher, Charles Plosser, and Kevin Warsh. Bernanke did not correct the misperception. Well, this fear of inflation, I think, is way overstated. We've looked at it very, very carefully. We've analyzed it every which way, Bernanke said. Then Bernanke said something that tainted the understanding of quantitative easing for years. One myth that's out there is that what we're doing is printing money. We're not printing money, he said. The amount of currency in circulation is not changing. The money supply is not changing in any significant way. This statement was fundamentally untrue. The money supply was already changing in significant ways and would never return to the already elevated level where it had been on November 3rd. The people who understood this fact best were the people, like Honig and Bernanke, who understood how the mechanics of the Fed's power actually worked and who understood what it was actually beginning to do after the FOMC cast its vote. Beginning on November 4, 2010, the American financial system began to orient itself around a central hub, located at 33 Liberty Street in Lower Manhattan. This was the address of the Federal Reserve Bank of New York, where the new era of quantitative easing would begin. The New York Federal Reserve employs a team of financial traders who usually arrive for work early, sometimes before sunrise, so they can be ready for a regular morning meeting at 9:05. The trading floors are hushed and serene, with murmured conversations and the clacking of keyboards. The long rows of cubicles are filled with analysts who tend to skew young. Genes are not uncommon. The cubicles are decorated in the way of cubicle farms everywhere, with small personal effects that struggle to overcome the joyless conformity. A bright red Rutgers pennant was tacked to one wall at one point, family photos to another. Anemic-looking plants on windowsills struggle to survive in the weak light. In many ways, it resembles any other trading floor in Lower Manhattan. But the Fed traders have special powers. Their first power is access to information that would make a big bank envious. Because every bank keeps a reserve account inside the Fed's traders can see just how much money each bank holds in its reserve vaults. The Fed can also monitor the overnight loans exchanged between banks, because those loans are made through the Fed's own transaction system. This private information is then coupled with over-the-counter data services like Bloomberg terminals to give the Fed traders an unparalleled view into America's banking system. This knowledge is combined with the second, far-reaching power enjoyed by Fed traders. They are the only traders in the world who can buy things by creating new dollars. This is the basis of the Fed's ability to influence the economy and the banking system. It is often said that the FOMC sets short-term interest rates, which is true, to a degree. The FOMC sets a target for the short-term rates. It is the traders at the New York Fed who make that target a reality. For many decades, they did it by buying and selling securities at exactly the right amount to make the cost of money exactly what the FOMC wanted it to be. If the FOMC wanted interest rates to go down, then the New York traders would go out and buy treasury bonds, using newly created dollars. This had the effect of sucking treasury bonds into the Fed and pushing out new dollars in return. This meant that there were more dollars to go around, which lowered the cost of borrowing money, which is just another way of saying it lowered the short-term interest rate on money. When the FOMC wanted interest rates to rise, the traders did the opposite, selling treasury bonds and sucking in cash in the process, making money more scarce and therefore more expensive to borrow, as expressed in higher interest rates. The New York Fed trading team did this with the skill and expertise of a piano tuner, managing to keep the money supply at exactly the right level of tension to produce the interest rate the FOMC asked for. Unlike so much of America's infrastructure, the Fed's system for influencing financial markets was pristine and assiduously maintained. Its power and reach were breathtaking. The Fed would put this machinery to a new use on November 4th when it launched the second round of quantitative easing. Now the Fed wasn't just trying to control short-term interest rates. It was trying to stimulate the entire U.S. economy. The program was operated out of a surprisingly small room located at one corner of the trading floor, where the Fed traders bought and sold things in order to control the money supply. At an appointed time, sometimes twice a week, a Fed trader went into the room and closed the door behind them. They sat at a terminal accessing the Fed's proprietary trading system called Fed Trade. The Fed had used this system for decades, almost daily, to buy and sell short-term securities from the most exclusive group of financial institutions in the world. These were the roughly 24 primary dealers that had the special privilege of doing business directly with the Fed. The primary dealers included big banks and investment houses like Goldman Sachs, J.P. Morgan, Citigroup, and Credit Suisse, and smaller players like Nomura Securities International and Cantor Fitzgerald. From the terminal, the Fed trader put out a bid on a specific asset, like long-term treasury bonds or mortgage-backed securities, then waited to see which primary dealer was willing to sell at the best price. The Fed always drew bids for its auction for a simple reason: it was the most powerful buyer in the world. It could simply create however much money it needed to close a deal. When the Fed and J.P. Morgan agreed on a price, say $10 billion for a bunch of treasury bills, for example, then the trader at J.P. Morgan would send its treasury bills to the Fed. This was the moment when the Fed trader entered a few keystrokes at the computer terminal and created the money for the transaction. When the J.P. Morgan trader checked the balance of the bank's reserve account at the Fed, $10 billion new dollars had appeared to fund the transaction. This is how the Fed created money on Wall Street. It took in an asset and paid for it by making new dollars inside the reserve accounts of primary dealers. Starting in November, the Fed traders did this transaction over and over again until they had created several $100 billion inside the Wall Street reserve accounts. There is one more important part of this process to understand. The primary dealers were not just selling the treasury bills and mortgage bonds that they happened to have on hand. If that had been the case, it would have limited how much money the Fed could have pushed into the banking system. Even the primary dealers only had a finite amount of such assets on hand. Instead, the Fed set up a conveyor belt of sorts, which used the primary dealers as middlemen. The conveyor belt began outside the Fed, with hedge funds that were not primary dealers. These hedge funds could borrow money from a big bank, buy a treasury bill, and then have a primary dealer sell the treasury bill to the Fed for new cash. In this way, the hedge funds could borrow and buy billions of dollars in bonds and sell them to the Fed for a profit. Once the conveyor belt was up and running, it began magically transforming bonds into cash. The cash didn't stay safe and sound inside the reserve accounts of primary dealers. It started flowing out into the banking system, looking for a place to live. The money changed the world, primarily by changing the behavior of people and institutions that already had a lot of money. Each dollar created by quantitative easing put pressure on the dollars that already existed, like water pushing into an overflowing pool. This pressure was intensified by the fact that the Fed was already holding short-term interest rates at zero. The Fed was essentially coercing hedge funds, banks, and private equity firms to create debt and do it in riskier ways. The strategy was like a military pincer movement that closes in on the opponent from two sides. From one direction there was all this new cash, and from the other direction there were the low rates that punished anyone for saving that cash. The Wall Street types developed a name for the strategy. They called it ZIRP, which was short for zero interest rate policy. Economists talked about ZIRP in terms of interest rates, but on Wall Street there was a deeper appreciation for the combined power of new money and low rates. The hedge funds and investors could see how ZIRP was reshaping the world, because they were the people who were doing it on ZIRP's behalf. To understand the effects of ZIRP, it's useful to think about the whole thing from the perspective of a greedy hedge fund manager who had to make a living in the world that ZIRP created. This hedge fund manager might have participated in the debt-to-cash conveyor belt and sold treasury bills to the Fed for a profit of $1 million. A $1 million profit is unrealistically small for a hedge fund owner, but the round number helps for the sake of this scenario. The first thing this hedge fund manager is going to think about, when that $1 million lands in their account, is the prevailing interest rate. The interest rate imposes a lens through which they will view everything else, because the interest rate is what the $1 million can pay them for doing nothing. If the interest rate on a long-term treasury bill is 4%, the hedge fund owner can stash their money in treasuries and earn $40,000 a year, essentially risk-free. Lots of people are going to visit this hedge fund manager to convince them not to stash their money in treasuries but, rather, to invest their money in whatever scheme that particular visitor happens to be promoting. There are many kinds of people who visit hedge funds asking for money. There are pathologically optimistic oil executives from Texas, raising money to drill fracking wells. There are commercial real estate developers from Miami, with plans to build new luxury condominiums. There are stock portfolio managers who use the word diversify so much that it sounds like a holy incantation. These people parade through conference rooms and display their PowerPoint presentations, and they always have a sword hanging over their head. The sword is the 4% interest rate. They all need to make a very convincing case that their project, whatever it is, will produce a profit higher than 4%, which is the riskless return on a 10-year treasury bill. This is how things worked for decades, but they no longer worked that way after 2010. Short-term interest rates were held at zero for many years, which meant other interest rates were also historically low. Quantitative easing intensified this effect in an intentional and strategic way. The program's primary goal of quantitative easing was to make sure that the long-term benefit of saving money was lower with each passing month. The New York Fed traders achieved this effect by purchasing certain treasury bills, namely the longer-term bills, such as the 10-year treasuries. This was new. In earlier years, the Fed controlled the money supply by purchasing only short-term treasury bills. The Fed was buying the long-term bills because doing so was like closing the one safe deposit box where Wall Street investors could stash money. Before the financial collapse that started in 2007, the reward for saving money in a 10-year treasury was 5%. By the autumn of 2011, the Fed helped push it down to about 2%. The overall effect of ZIRP was to create a tidal wave of cash and a frantic search for any new place to invest it. The economists called this dynamic the search for yield, or a reach for yield, a once obscure term that became central to describing the American economy. The people who had real money, meaning billions of dollars, were set on the search for investments that yielded anything more than zero. Now when a pathologically optimistic fracking wildcatter visited the hedge fund, they got a far more sympathetic hearing. Their PowerPoints included figures on the productivity of oil wells that might seem riskily inflated. But the hedge fund manager was more likely to think, why not? It beats zero. The Miami condo developer talked up sketchy forecasts about the demand for new units, but taking a chance on the project still beat zero. And the well-dressed portfolio manager who was pushing shares of stock, Shares that seemed wildly expensive when compared to actual profits of the company underpinning them, that investment also beat zero. The search for yield didn't just pressure risk-hungry hedge fund managers. It also pressured the most conservative and wealthy institutions, like big pension funds and insurance companies. These institutions had enormous sums of cash, and they depended on interest payments to remain solvent. When interest rates are 4%, a pension fund might be able to meet all of its payment obligations with just $10 million saved in treasury bills, because the $10 million will kick off regular interest payments. When rates are pushed close to zero, the pension fund is suddenly insolvent and must start a search for yield. Now even the pension fund will be taking a hard look at fracking wells and luxury condo developments. This is why ZIRP caused asset prices to rise. When people search for yield, they buy assets. This increased demand drove up the price for corporate bonds, stocks, real estate, and even fine art. The asset price inflation was not an unintended consequence of quantitative easing. It was the goal. The hope was that higher asset prices would create a wealth effect that bled out into the broader economy and created new jobs. It was entirely clear to senior leaders at the Fed that to achieve the wealth effect, ZIRP must first and foremost benefit the very richest people in the country. That's because assets are not broadly owned in America, according to the Fed's own analysis. In early 2012, the richest 1% of Americans owned about 25% of all assets. The bottom half of all Americans owned only 6.5% of all assets. When the Fed stoked asset prices, it was helping a vanishingly small group of people at the top. The people who benefited most from this arrangement tended to talk about it the least. Very few hedge fund operators seemed eager to complain about the way that ZIRP widened income inequality and fueled speculative debt bubbles. One of the unspoken rules of Wall Street, in fact, is that those who know, don't show. If a trade is turning a profit, then people who know about it don't talk about it because doing so might draw a crowd and risk the trade itself. So the public rhetoric around quantitative easing remained dominated by inflation doomsayers who focused only on price inflation, which never materialized. The arguments made by people like Tom Hoenig were mostly ignored. And, after 2010, he would no longer be making them inside the FOMC. In early 2011, Hoenig retired from the Kansas City Fed at the age of 65. When NPR did a story about it, they referred to him as Fed dissenter Thomas Hoenig. His reputation had been set. In January, Hoenig gave a speech in Kansas City to a local business group. It was basically his goodbye speech as a Fed president. He didn't use the occasion to press his arguments against quantitative easing or 0% interest rates. He gave a short speech, instead, about the value of dissent inside the Fed. He pointed out that the FOMC had been constructed to include members from around the country, not just Fed governors who were appointed in Washington, D.C. In this structure, it is a key point to remember that each FOMC member was given a vote, not an advisory role, Hoenig said. A deliberative body does not gain credibility by concealing dissent when decision-making is most difficult. Hoenig had dissented, and he had lost. The monetary experiment was now underway. As for me, I recognize that the committee's majority might be correct. In fact, I hope that it is. However, I have come to my policy position based on my experience, current data, and economic history, he said. If I had failed to express my views with my vote, I would have failed in my duty to you and to the committee. Between November 2010 and June 2011, quantitative easing pushed $600 billion new dollars into the financial system. The monetary base of the United States, meaning the core pool of new money that only the Fed can create, rose by a total of $720 billion between November 2010 and June 2011. In about 7 months, the Fed injected more money into the banking system than it had in the 30 years prior to 2008. The banks were overflowing with more cash reserves than they had ever seen in history. By the summer of 2011, the value of excess cash reserves in the banking system reached $1.60 trillion, an increase of 96,000% from pre-crisis levels. At first, there were encouraging signs that ZIRP might be helping the broader economy. The unemployment rate began to fall, slowly but steadily, in the months after quantitative easing ended. But as time passed, the broader benefits that Bernanke and others had hoped for proved elusive. When quantitative easing was launched in November, the unemployment rate was 9.8%. When the program finished in the summer of 2011, the unemployment rate was still 9%. Economic growth was, by the Fed's own measures, still anemic and uncertain. To achieve these small gains, the Fed had distorted the financial system in ways that would not be easy to undo. Ben Bernanke became single-minded in his drive to do more. If the new round of quantitative easing worked only marginally well, then maybe another, even larger round might work better. If the banks weren't lending as much money as the Fed desired under the pressures of ZIRP, then ZIRP could be intensified. This is what Bernanke proposed doing in the summer of 2012. But this time, Bernanke would face more opposition than he had faced in 2010. During an FOMC meeting in the summer of 2012, 6 out of the 12 FOMC members expressed skepticism about launching a new round of quantitative easing. If even 3 of these members voted against Bernanke's plan, it would show the world that the Fed was uncertain about its experiments. Bernanke worked hard to make sure this didn't happen. He began politicking within the FOMC, building support for his plan to escalate the Fed's intervention. Bernanke's strongest opposition came from a group of 3 Fed governors who began to work together to slow or hinder his plan. One of these governors proved to be a formidable critic of ZIRP, at least within the closed sessions of the FOMC meeting. His name was Jerome H. Powell, and he was a relatively new addition to the Fed board, having been appointed by Barack Obama in 2012. Powell raised many of the same concerns that Honig had raised. But Powell came to those concerns from a different path. He had spent his career in the world of private equity dealmaking. He had grown wealthy helping create and sell risky debt. When he joined the Fed, he began to point out just how risky the debt could become to the broader economy. Unlike Thomas Honig, Jerome Powell would actually be listened to. He would, in fact, rise to the highest levels of power inside the Fed. And during the years that he ascended to the role of Fed chairman, he provided some of the clearest warnings of just how dangerous quantitative easing might become. There are many factors that affect the yield of 10-year Treasury bills, and those factors worked in concert with the Fed's actions to drive down the rates over time. Bernanke estimated that the first rounds of quantitative easing alone probably drove down the 10-year yields by between 1.1% and 0.4%, while the second round cut about 0.15 to 0.45% off the yield. OceanOfPDF.com. Part 2. The Age of ZIRP. OceanOfPDF.com. Chapter 7. Quantitative Quagmire, 2012 to 2014. When Jerome Powell joined the Fed Board of Governors, he joined one of the strangest, most isolated workplaces on earth. The Fed governors work out of well-appointed offices that line a long hallway in the Eccles building, near the cavernous, ornate boardroom. Though they work on the same floor of the same building, the governors didn't simply pop into one another's offices to ask for advice or share a thought. Discussions were set up by appointment, through the governor's assistants. One of Powell's neighbors as a governor was Elizabeth Betsy Duke, a former bank executive and chairwoman of the American Bankers Association. Duke said she was struck by just how isolating it was to be a Fed governor. "It was the loneliest job I ever had," she recalled. The social atmosphere was a strained one, but Jerome Powell managed to fit into it smoothly. This was one of his primary skills in life. Powell was charming, smart, and even humble in his way, with a self-effacing humor that was impossible to fake. Everybody called him Jay. He had spent his career inside the corridors of American power, moving back and forth between the institutions of big government and big money. When Jay Powell was around the most powerful people in the world, he knew what to say and how to say it. He grew up in the wealthy suburbs of Washington, D.C., attended Georgetown Law, and then went to work on Wall Street in the investment world. After that, he had a senior position in the U.S. Treasury Department under the first President George Bush, and then he jumped to a very powerful private equity firm called the Carlyle Group. Carlyle was so rich, and run by a group of Washington insiders who were so powerful, that it spawned a number of conspiracy theories that were surpassed only by the Federal Reserve. After his time at Carlyle, Powell was very wealthy and joined a think tank in Washington. He was nominated to be a Fed governor by Barack Obama as part of a compromise deal. Obama nominated one liberal, a Harvard professor named Jeremy Stein, and one conservative, who was Jay Powell. Powell arrived at the Fed in May 2012, just as the FOMC was entering a period of tense debate. Ben Bernanke was pushing for a new, much larger round of quantitative easing, but he was facing an unprecedented amount of dissent within the committee. Debates inside the FOMC that summer revealed a remarkable level of skepticism and outright opposition to Bernanke's plan. During the meeting in late July, about half of the voting FOMC meeting members expressed concerns about quantitative easing. Bernanke began to push hard against this opposition because economic growth remained weak, and the unemployment rate remained high, almost 4 years after the crash of 2008. This long period of anemic growth was entirely expected and predictable because of the big debt overhang that remained from the housing bubble, but Bernanke felt pressure to act and to keep the Federal Reserve at the center of efforts to boost the American economy. To achieve this, Bernanke pushed the Fed to use tools that were once considered experimental, even radical, but were now the only tools at the Fed's disposal. The Fed had already employed 2 of its most powerful tools by the time Powell arrived. The first was forward guidance, whereby the Fed guaranteed that it would keep rates low, encouraging more lending and speculation. In January, the Fed had signaled it would keep rates at zero for nearly 3 more years, an extraordinary escalation of the guidance. The second tool was Operation Twist, a bond buying program similar to quantitative easing, but with one important difference. Operation Twist didn't pump more cash into the banking system, but only sought to encourage more lending by pushing down the interest rates on long-term Treasury bills. The Fed had launched a new Operation Twist operation in late 2011 and extended it in 2012. But as summer rolled around, Bernanke needed something more. He turned to the final, most powerful, and most controversial tool, quantitative easing. Bernanke began to push for a larger, longer-lasting round of quantitative easing, arguing that maybe this new round would accomplish what the previous round had not. Quantitative easing had now become a normal tool of monetary policy and had even earned its own shorthand description at the Fed and on Wall Street, where people referred to it simply as QE. But even as it was normalized, internal dissent against QE was growing inside the FOMC. Bernanke faced resistance from Fed governors and multiple regional bank presidents. This growing dispute put pressure on Jay Powell to figure out where he stood and to figure it out quickly. A series of FOMC votes in July, August, and September would determine the future course of the Fed and the financial system. Powell began to work closely with Betsy Duke, a vocal critic of quantitative easing. Both Powell and Duke had come to the Fed from the world of private banking and finance, so they shared a certain sensibility and a technical understanding about the way the Fed influenced the real world of hedge funds and banks. It seemed to be this knowledge that made them skeptical about another round of QE. Duke expressed her concerns repeatedly and forcefully during several FOMC meetings. She was worried that more QE would just build up more risk in the financial system, without doing all that much to help the real economy. She was also deeply worried that the Fed didn't seem to have an exit plan. Quantitative easing was easy to execute but difficult to reverse. And reversing QE became more difficult the larger the program became. Duke's concerns were amplified by two regional bank presidents, Richard Fisher from Dallas and Jeffrey Lacker from Richmond. Fisher thought QE encouraged risky speculation and asset bubbles. Lacker feared that more QE would make it harder for the Fed to ever raise interest rates again. Jay Powell had an outsized influence in this debate because he was a governor. Bernanke focused his energy on lobbying the governors to get behind his plan in a way that safely neutralized any objections that might come from cantankerous regional bank presidents. That was the way the Bernanke Fed worked, Betsy Duke recalled. You didn't have dissent from any of the governors? Bernanke viewed it as a particularly big deal. He said he didn't want dissents. When Bernanke lobbied the Fed governors, the lobbying was aimed at a particular goal. The goal was to build unanimous support among the governors for something called Option B. When the FOMC members gather for their official meeting, they generally consider three policy options before voting on one. The options are labeled A, B, and C, and arranged like Goldilocks's porridge, ranging from hottest to coldest in their effect on the money supply. Option A was usually the most aggressive, like a round of QE that would be worth $1.50 trillion, while Option C would be extremely conservative, like doing no QE at all. Option B was always structured to be just right. Bernanke spent his time between meetings formulating an Option B that satisfied the governors and guaranteed their votes when the meeting came around. The objective, always, for the meeting, is to come out with Option B, Duke said. Bernanke was willing to accept one dissenting vote from a regional bank president, but not much more than that. In his very first meeting at the FOMC, Powell was diplomatic and warm. He voted for Option B, but Powell also signaled that his thinking would hew more closely to Betsy Duke's than to Ben Bernanke's. Powell opened his remarks with something that would become a habit of his. He talked about what his friends and contacts were saying in the private sector. He often surveyed his contacts with precision and rigor. In one meeting he broke down their responses by percentage, like a Gallup opinion poll. During his first meeting in May, Powell said that QE should be reserved as a backup tool, something to be used as a defensive weapon going forward. He indicated that the weapon was probably not needed now. His industry contacts said that growth was slow, but he wasn't convinced the slowdown would last into 2013. This critique was hardly as sharp as others that were expressed against QE during the meetings, but it signaled that Powell's support could not be taken for granted. Bernanke lobbied the governors between meetings, an easy job because their offices were a short walk down the hallway from his own. He lobbied them as a politician might do, building support for his cause and seeking to isolate opponents who might hinder it. The FOMC discussions were open and transcribed for history, but Bernanke's private meetings were not. This allowed people to speak freely. Betsy Duke very much enjoyed these meetings, even when she disagreed with Bernanke. He was a great listener. When Bernanke tried to persuade the Fed governors, he did so respectfully and intelligently. He presented them studies, and he read the studies that they provided in response. He called them unexpectedly. He traded emails and debated. The process wasn't necessarily contentious. Duke, for one, enjoyed the back and forth. Duke and her colleagues were not an easy sell on QE. Everyone seemed to agree that you had declining benefits, she recalled. And those tiny benefits came with large risks down the road. The concerns were, how do you exit? How do you stop? One of Bernanke's secret weapons in the lobbying effort was his vice chairwoman, Janet Yellen, the former president of the San Francisco Fed. Yellen was an assertive and convincing surrogate for Bernanke, and she championed an expansive use of the Fed's power. Betsy Duke had become close with Yellen early on. They talked over a private dinner and commiserated about the strange isolation and stress of being a Fed governor. Yellen joked that she could have keeled over dead in her office at the Eccles building and no one would have found her body for days. Yellen was friendly, even jovial, when she pressed her views. But she was not in any way ambiguous. Janet was the strongest advocate for unlimited, quantitative easing, Duke recalled. Janet would be very forceful. She is very confident, very strong in promoting the point of view. Yellen and Bernanke were convincing, and their argument rested on a simple point. In the face of uncertainty, the Fed had to err on the side of action. Bernanke pushed this view to Duke, along with other wavering FOMC members like the regional bank presidents Sandra Pianalto of Cleveland, Dennis Lockhart of Atlanta, and Narayana Kocherlakota of Minneapolis. All of this lobbying meant that the key policy decision-making was essentially finished by the time the regional bank presidents traveled to Washington to vote. The regional presidents seemed to sense this fact, and they tailored their criticisms to affect future votes, or give cover to Fed governors who might want to break ranks. Richard Fisher, the Dallas Fed president, had grown adept at this art. During the FOMC meeting in late July, he gave a long, impassioned speech against Bernanke's push into deeper and deeper interventions. Fisher didn't just argue on the philosophical merits of the Fed's ZIRP policies. He presented a specific, detailed case study illustrating how the policies were already causing dangerous distortions in the economy. Fisher said that he had recently spoken with the chief financial officer of Texas Instruments, who explained how the company was managing money in the age of ZIRP. The company had just borrowed $1.50 billion in cheap debt, but it didn't plan to use the cash to build a factory, invest in research, or hire workers. Instead, the company used the money to buy back shares of its own stock. This made sense because the stocks paid a dividend of 2.5%, while the debt only cost between 0.45% and 1.6% to borrow. It was a finely played maneuver of financial engineering that increased the company's debt, drove up its stock price, and gave a handsome reward to shareholders. Fisher drove home the point by relating his conversation with the CFO. He said, and I have his permission to quote, "I'm not going to use it to create a single job," Fisher reported. And I think this is the issue. We work under the assumption that lowering the cost of capital and providing cheap money encourage businesses to lever up and to use that levering up to expand capital investment and job creation, which is part of our mandate. I don't believe that's happening. Fisher was describing, specifically, how ZIRP was already building up systemic risk in the economy without creating a single job. Bernanke rarely responded directly to such statements, but in this case he made an exception. "Thank you," Bernanke said. "President Fisher, I know we put a lot of value on anecdotal reports around this table, and often to great credit. But I do want to urge you not to overweight the macroeconomic opinions of private sector people who are not trained in economics." With this comment, Bernanke seemed to have inflicted upon Fisher the most humiliating wound possible in the culture of the FOMC. He had exposed Richard Fisher as being unsophisticated. Neither Fisher nor, presumably, the CFO of Texas Instruments had earned a PhD in economics. This put them at a supposed disadvantage when it came to comprehending the effect of programs like quantitative easing. The Fed's leadership sometimes acted as if only the army of trained economists of the Fed, up to and including its chairman, could understand the design and the effects of the Fed's actions. The implied superiority of economists was a very real force at the Fed, on display at every FOMC meeting, when PhD-trained staff gave long and minutely detailed presentations about the policy choices at hand. The Fed historian Peter Condi Brown showed how this dynamic helped consolidate power into the hands of trained economists at the Fed like Bernanke and his staff. Without a PhD in economics, according to one former governor, the Fed's staff will run technical rings around you, Condi Brown wrote in his 2017 book, The Power and the Independence of the Federal Reserve. This power was also directed against critics like Powell and Duke, who came from the world of banking rather than academia. During the July meeting, Jay Powell took a measured approach. He bluntly acknowledged that QE would stoke economic growth primarily by first stoking asset prices. "I suspect that the channels that we're using now, which principally are asset prices, may not be working at all as well as our models say," Powell said. QE was building up risks in the economy, he continued, but the risks were probably manageable. Still, he didn't think another round of QE was necessary. "And for me, I think that the bar for another large LSAP is high and not yet met," he said, using an alternative acronym for QE. LSAP stands for Large-Scale Asset Purchase, and people at the Fed use it interchangeably with QE. Bernanke did believe the bar had been met, but by late July he still could not push the FOMC to agree with him. The option B approved at that meeting was a lukewarm statement that didn't commit to another round of QE. Bernanke had a chance to change this in late August, when he was invited to speak at the prestigious Jackson Hole retreat. He had used that venue to build support for quantitative easing in 2010. Now he would do it again. The weather was beautiful as the elite economists and central bankers arrived at Jackson Hole, and Bernanke's speech was seen as the main event. But Bernanke had cause to feel gloomy. The attendees were hardly more friendly to Bernanke's plan for more QE than were the members of the FOMC. Even at Jackson Hole, there was deep dispute about what the Fed was doing. Some economists argued that QE wasn't even achieving its primary goal of lowering long-term rates. Others argued that it had done that, but wasn't creating any meaningful gains for the economy. The dour-looking and influential Harvard economist Martin Feldstein spent a lot of his time at Jackson Hole walking around and badmouthing Bernanke's policies to any media outlet that would listen. The networks were eager to hear Feldstein's views because he was an advisor to the Republican presidential candidate Mitt Romney. In an interview with Fox Business, Feldstein said that the U.S. economy was in a deep hole, but pointed out that low interest rates and cheap lending would do nothing to fix the real problems that afflicted the country. "I don't think there's much the Fed can do," Feldstein said in a quote to the Wall Street Journal that was even more direct. "The Fed is at a point where another round of quantitative easing would be a mistake." Bernanke's speech that year was presented as an assessment of the Fed's actions since 2008. It carried a neutral title, Monetary Policy Since the Onset of the Crisis. Bernanke purported to weigh the benefits and the costs of policies like quantitative easing, forward guidance, and Operation Twist. He seemed to be very careful not to use common English or to talk about what the Fed was doing in a way that might accidentally be understood by anyone without an advanced degree in economics. To give just a flavor, when Bernanke described the way that QE affected markets, he said, "One mechanism through which such purchases are believed to affect the economy is the so-called portfolio balance channel. The key premise underlying this channel is that, for a variety of reasons, different classes of financial assets are not perfect substitutes in investors' portfolios." Bernanke's very dense speech outlined the potential benefits and the potential drawbacks of QE. This approach helped his campaign to build more support for QE precisely because the benefits and costs were so hard to measure. One economist's asset bubble was another's healthy market. His speech meandered through this ambiguous terrain until Bernanke uttered one line that would truly move markets. Overall, however, a balanced reading of the evidence supports the conclusion that central bank securities purchases have provided meaningful support to the economic recovery while mitigating deflationary risks, he said. This was the statement that would be carried at the top of the Wall Street Journal's story on Jackson Hole. Bernanke was saying that QE worked. He was also saying that the Fed would not rule out the further use of such policies. It was a clear signal to Wall Street that the traders ought to hitch up their horses and get ready to ride. Bernanke's speech overrode the deep divisions on display inside the FOMC by fueling the so-called announcement effect. This happens when the very hint of a new action from the Fed changes what investors expect, which then makes the market prices start to change. Bernanke had benefited from this effect in 2010, when he fed the expectation that another round of QE was on the way, causing some stock and bond prices to rise. This meant that not initiating another round of QE would cause prices to fall, putting a very heavy burden on any FOMC member who might vote no. If Bernanke was slowly squeezing his own FOMC into a narrow set of choices, he justified what he was doing by pointing to two very large economic threats, one foreign and one domestic, that he believed justified his plan. The foreign threat came from Europe. The domestic threat came from Congress. In Europe, the financial crisis of 2008 had never really ended. The debt overhang in Europe was simply astounding. Just 3 European banks had taken on so much debt before 2008 that their balance sheets amounted to 17% of the entire world's GDP. Europe was crippled for years. European banks and governments owed their debt in dollars, so the European Central Bank couldn't just create more dollars to bail them out as the Fed had done in the United States.